I have, like Munger says, we are old too soon and wise too late. What is gradually sinking in is a willingness to pay up. And the other thing that is sinking in is, which is more important, is a willingness to hold. So it is not, I mean, the two big mistakes that I have made aren't, I mean, one is very obvious, passing on a number of great businesses because they looked optically overpriced. Okay, in the end, it turned out they were not overpriced, but when you looked at them, they looked expensive. It's just that they were such awesome businesses that you could have paid 30, 40 times earnings and still done really well on them. And the second more difficult thing is that you buy something that's an incredible business. Maybe it's available at 10 times earnings and it's worth 20, 30 times earnings. And it does well, it gets to 20, 30 times earnings and you sell it. And it keeps going. And that's the other thing. So those are the two big mistakes, is being too much of a cheapskate, not paying up, and being too much of a cheapskate and not willing to hold. And I'm hoping to get better at both of those. So there's still a lot of learning and growth for me to do.
Do you have any other routines to not forget the lessons that you learned?
No, I think the main thing I try to hammer into my head every day is the very simple notion that capitalism is very brutal. There are very, very few businesses that are truly exceptional businesses. If you find yourself in the favored position of being an owner of such a business, don't worry about the valuation. So I'll give you an example. When I made the Fiat Chrysler investment, embedded inside that 5 billion of Fiat Chrysler was Ferrari. They owned like 90% of Ferrari. And then a few years later, they took Ferrari public. I think Ferrari is at about $270 a share right now. And effectively, when I look back at when I made the investment in 2012, I got my Ferrari shares at about $13. So it's gone up about 20 times since the 2012 to 2021 or 22 is about 20 times. And the thing is that when they took it public, it came public at $40 or $45 a share. And my thinking was that, okay, these guys are pretty smart. When companies go public, they will try to extract, maximum value. They're not going to take it public when it's undervalued. So I thought maybe Ferrari's worth $50, $60 a share or something. Who knows, right? It wasn't the part of the business that I was very focused on. I was focused on all their Jeeps and Ram trucks and all of that, and I'd really figured that business out. This business was a little strange because it came public at like 40 times earnings, so that already is, above my pay grade. I didn't think it's going to go to 200 times earnings, and I think I sold some Ferrari at 60 and 100 and maybe 130 and so on, and all those prices I felt were pretty good. And in hindsight, the unfortunate thing was I bought a Ferrari, but I bought it after I'd sold the stock. I really understood the business after I bought my car. And that's when I realized what the moat of Ferrari is and why it is such Ferrari is a business that can earn whatever it wants. It can have whatever net income it decides it wants. It's in a very favored position. They are one of the most well-recognized brands in the world. And in 70 plus years of history, they have never spent $1 on advertising. There is no other brand I know that's in the top 10 or top 5 most well-known brands on the planet that got there without a boatload of advertising. Just look at Coke, for example.
Oh yeah.
So what I'm just saying that this is a very unusual business where even today, from 2022, going back to 1950 when Enzo Ferrari formed the business, they have never advertised.
Some stocks will never fall to the price you want, and that's not a mistake. That's the market telling you something. When a company has visible earnings growth, a rock-solid balance sheet, and a trusted brand, and management that clearly communicates long-term plans, the market isn't going to sell it to you cheap. As Charlie Munger said, A great business at a fair price is better than a fair business at a great price. These businesses often trade at a premium valuation. That does not mean they deserve a PE of 100 or insane multiples, but a 40 to 50% premium to the sector PE is completely normal. If you take any sector and calculate the average PE, you will always find 1 or 2 leaders trading much above the pack. Why? Because leadership, consistency, and growth deserve a premium. Look at the paint sector in India. The market leader always trades higher than others. The story is different for IT. The fast growers get rewarded. Persistent System has grown revenue at 28% CAGR, Coforge at 24% CAGR over the last 5 years. And naturally, the market values them higher. As the saying goes, the market pays for performance. These are just examples and not recommendations. Try these exercises across sectors and you will realize why some stocks always look expensive and stay expensive. And sometimes you must be willing to pay a higher PE for a genuinely great business. Because waiting for the perfect price may mean missing the entire opportunity.